Huge volatility swings ahead of Powell's speech tomorrow. Several key trend lines to go over for the S&P and what to watch ahead of that speech. Two sectors that are continuing to set up to break out. Why utilities closing near the high of the day is important. One long-term indicator flashing a sign only seen 4 times in 20 years. 5 stocks to go over for tomorrow, including Apple and the Goldman Sachs coverage and $200 target price. The S&P has this DTL or downward trend line. Now we can see right here how we've been bonking our head around it, not able to get through it. If we overlay this with a 200-day moving average, we can see how we swooped in and caught it right here. And all we're really doing is just filling in here. That's all we've been doing so far. If you zoom in on this and the 60-minute charts right here, you can see our level pretty clean. Trying to rally up doesn't really get that high and then pulls back. Now we need to dive into this pullback. You can see where resistance is. It was a previous close on the 17th of February. And this is pretty textbook stuff. This is usually what happens. We gap fill one gap and then we go back and fill another gap. This is what basing looks like. It's frustrating to people, but this is what it looks like. You will literally fill in one gap, right? And then you will go and then fill in the next gap, wherever that may be. It's just the way that the market is going to work as it goes through a basing period, which is something that I believe we're going through, and we'll get more into that in a moment. If you take a look going straight across here, you can see that all we did by the end of the day was very simply just gap fill. So we didn't really do anything of consequence. Now, it was painful for people if we bought up here during the day and then comes back down. And if you're trying to day trade, it makes life a little bit harder. If you're trying to swing trade, you're going to have to expect something called volatility. It's just the way that it is. A lot of people are used to the market having 2 very specific levels. They're used to this, as we had after the pandemic, or they're used to this, which we had after the pandemic. What people don't seem to be used to is something very simplistic as this, where we are up and down, up and down. And that's just the way that it goes when you're building a base. And that's exactly the stage that I believe that we're in right now. Expanding our little drawing out, you put this on a daily and you can see pretty clearly. And there's some things that we should probably go over here. So this was the bottom of the market on mid-October. It looks like October 13th to be exact. And if we just come across here and look for a moment, okay, it has been 144 days since we have taken out a new low. So I'm not really sure for people that are in the camp that we're going to take out a low. Even at this point, let's say you do take out that low. You just missed 144 days of the market going higher, grinding higher. No matter how you slice this, we are grinding higher. Okay, you might not like it. You might not agree with it. Your economic data and economic data read might suggest differently, but this is what's happening. And you need to trade what's actually happening, not what you want to have happen. Just a very quick reminder, we still have the golden cross down here. I know some people are not fans of this particular pattern, but I like it a lot. 55 is crossing the 200. Pretty clean. Cannot break. It just was tested 3 times. 1, 2, 3. Not only do we have the signal, we have the test of the signal. So in other words, when you have a golden cross, 1, 2, 3. Once you have a golden cross, the 200 is supposed to become your support. If you have a death cross, it becomes resistance. If we look back previously when we had the death cross and we see the 200, we can see how once that happened, this became resistance repeatedly. And of course, things are resistance until they change. The old adage, the trend is your friend until it's no longer the trend. But it's pretty hard for me to be overly bearish here. And I've not been bearish for some time, but now I'm getting a little cross right here on the MACD. Make those lines a little bigger so it's glaring. We can see that turn right here. We can see the histogram, how the histogram has gone from dark to light red. And essentially what that means is that we have a peak. Does not always mean that you're going up. Does not always mean that it's just going to very simply flip to green, which is obviously what you want to see with the histogram. All the histogram is really doing is just measuring the distance between these 2 lines. You can see how it's getting tighter and tighter and getting ready to give us a signal. Does not mean that we're going to go straight up. What I'm suggesting is I find it very difficult to look at this market and just say very simply that we're going to roll over again. Now, there are 3 indexes I would like to show you, but before we do that, I just want to go through this graph, and this is really somewhat important. Now, before we get into 3 sectors, I'd like to go over this graph. This graph is panic and euphoria model. What this model does is take into account either extreme situations of glee and happiness where things look great, or it takes into account panic. And what I'd like you to focus on for a moment are those 4 spots. The green line And below the green line, it's a contrarian long-term indicator. I'm going to use those words again, contrarian and long-term. I'm not suggesting that this is something that you look at today and then therefore tomorrow something should happen. What we're looking for is what has happened in the past to possibly get a sign of what could happen in the future. Only 4 times we've been below this line and then flipped back over this 0 line. On the times that we have done this, we have seen a substantial move in the market until you get to the top of here, and then you start getting a little tired, and this is obviously where euphoria kicks in. If you just took this point right here and said when it flips back over this line, and we use that line as an indicator, and you just look at how it moves as it sits in there, you can start seeing that this is actually marking long-term bottoms on these charts over and over again. We have not seen this level of pessimism in the market. And I'm getting that. I'm getting that from your comments that are in YouTube, and I appreciate the comments. But if you go on social media and you look at how everybody's just waiting for the next bear market, and then you zoom in on the data and realize that you were at a level of panic in the market at the end of December that was equivalent to a global pandemic. That tells you the level of panic that was in the market. So it's quite possible that we put ourselves in a position where maybe we went too far up. And then, of course, what did we do next? Too far down. You can see how the euphoria marked the high of the market a couple weeks later. This is probably marking the low a couple months later. Again, our data set is over 20 years. It's not on a week, and we're looking long term. Every time that this has happened, it's put a bottom in and we have rallied. It's important context because as we take a look at what's happening in the markets, we look at the semiconductor index. You can see where the low is. And if we're sitting around waiting for that low to be taken out again, well, we're going to be waiting for a while. Right now, we're up about 46% from the bottom. Are you a trader or are you an economist? We can all talk about the economy and the macro, and it does drive the market. But at the end of the day, the market's going to do what the market's going to do, and we're going to have to trade with what we have. Left shoulder, head, right shoulder, neckline. Tries to get over the neckline, pulls back down. Tries to get over, pulls back down. So essentially, we pop down after the first 2 hours in the market, and we reject that line, and we reject semiconductors. Now, while that's going on, we know where the DTL is, or downward trend line. And did we take out a new lower low? No, we didn't. Matter of fact, all we really did was just come back to this area that's up here. Actually, we're a little below it, but we didn't really fall apart. That's all we did. We came back to levels that we saw last Friday around 12:30, and we still made the higher high. We just didn't stay there. Now, I also think it's important context to just look at a weekly chart for a moment, zoom out, and just look at where you're settling in and look at that little minor level. And let's see how minor that level really is. Well, we stopped here. It became resistance here, here. So this is a multi-year support and resistance line. Matter of fact, if we keep going, this line goes all the way back to January 2021. If we draw it all the way through, we can see the resistance here and how we've been battling this area. So because we didn't flip it on a Monday, I'm not going to get too concerned about one day and the fact that we didn't do it. What I would focus on, because what I'm going to be asked next is, what would concern me? Well, the first thing I would want to watch is just this little level right here. And I'd want to make sure that as we get wedged in here over the next couple weeks, keyword weeks, then we break out of it. I'd like to break to the upside. If we break to the downside, then that might mean that we're going to just trade around for a little bit more before we push. Now, another sector that is setting up to break out. Higher low, higher low, higher low. Industrials. Right up into our key level, right up in here, okay? So we're setting up to flip this level. And what I'm saying is this takes weeks. This does not take days for us to rebuild and get up there. Now, if you look at that level back here, you can see all the way from January 22, we're almost at all-time highs. We're almost at all-time highs in industrials. Now, you'll remember from our previous graph that the panic euphoria was around the 2009, 2016 pandemic, currently now. Let's zoom out and take a look at industrials during that period in time. There's industrials, 2016. There's the industrials, pandemic. They don't even look the same. 200-day moving average, we're above on industrials. Semiconductors, 200-day moving average, we are above. Financials, 200-day moving average, we are above. Please comment below. Go back in history and find me a time where the market took out new lows. So as long as financials, industrials, and semis are above their 200-day moving average, you have enough here that should hold us together. And instead of panicking when we're selling off, we should be looking at the names that we want to add to. The game's changed. And if you think we haven't bottomed, please comment. I like to understand, I don't know everything, so I always like to know what other people are thinking and what their comments are. I find it extremely helpful. So please comment below about what you think and what you're looking at, because I may be missing something, or you may show me something that I want to see. In front of us is utilities in blue and the S&P is in orange. In front of me, utility sector is in blue and the S&P 500 is in orange. What I want to show you is the correlation. You see the correlation, it's not exact, but it's there. As long as you don't see utilities rolling over, this is one of the reasons why you watch a lot of old school people. They always watch utilities. If utilities start to roll over for some reason, maybe ahead of when the market starts rolling over, i.e. like we did here a little bit, right? Then they're going to start paying attention. You can see it up here as well, how we started to roll over, and that gave us a little clear signal. You want to watch utilities. If utilities continue to rally or base, you want to stay and you want to watch and how that goes. It's very rare that utilities are going to go higher or flat and that the index is going to do something different. Apple was upgraded today by Goldman Sachs to their conviction buy list. They don't put names on there lightly. You have a $200 target price on Apple, one of the single largest companies in the world, and you have a $200 target price on it. If the largest or one of the largest investment banks in the world thought we were going to be in a bear market, do you think that they'd be putting a buy on a $1 trillion tech company? The answer is no. So obviously they have a belief that this is going to trade up over time. I would not bet against them. No, I actually will say this. I'm not crazy about today's action. I'm not crazy about how we sold off. The only thing that I didn't mind about it was that we didn't really break down. And I'm just going to show you a really quick trick here. You can see how we didn't break the open. You can see how this is one of the core names why we didn't gap fill. That says a lot. No one was panicking. Nobody cared whether or not they owned it at the same levels next Friday as about 80% of the stocks today actually gap filled. Apple did not gap fill. It went sideways, went to the open, and then stayed right there. Now in front of us, we have volume by price over here. Blue is buying, the orange is selling. And what I want to just point out to you is you can see when we got back down to this level, how much more buying we had than selling. Even when we were up here, you still had more buying than you had selling. So what this is telling us is that on the way down, it really just wasn't the selling, but it was the lack of buying as they were trying to get a better price. How do you know that? Because the buying increased as the stock dropped. How do I know that? Because I can see over here that this block is smaller than this block is smaller. This block, see how they make a ladder and they're coming down? That means as the stock's dropping, you're getting more buying as a percentage degree of these bars. This is the absolute, and then obviously the whole length of the bar would be relatively speaking, but the absolute moves are right here. So we're actually buying on the way down. This is a great way, if you look at this little stair stepper, this is a great way to determine what the heck is going on. Here's another really good example in a stock that should be on your list. You can see very clearly here, look at how we're stepping up as the stock goes up. So what's happening? Well, they're not selling. People are stopping selling when the stock goes higher. Well, shouldn't the selling be going up? Yep, it should, just like it did here. The selling should be going up. We should be getting more selling. It's drying up when we're up here, and we're getting more buying. As it was dropping, as we drop, we had buyers. And I think that's really important with these names. If you start looking for these stair-step patterns, you'll find support levels. KALA, if I leave in the volume by price right here, you can see I have the exact opposite. We had selling actually increase as it went up. Sure, we had more buying at this level, but there's a reason why this level had more buying. That is the anchored VWAP from the breakout. So one of the really quick tips to use, I use anchored VWAP at very specific periods on a chart. Other than that, you could put anchored VWAP everywhere and then just say, hey, look what it did over here. You need it to have significance. The significance of the anchored VWAP here is that this is when it changed trend. This is when we got out of all this nonsense and we started running. So this is the bar. These are the players, the new players that are in the name, and I want to know where they are. So from here going across to today's VWAP, we have a pinch. What's a pinch? A pinch is when you're between two different volume weighted averages. You're between today's and you're between the one when we broke out. Look how we're battling in here. See how we're battling? This leads to a pinch. This usually leads to a pretty violent move. So I have a long position in this. We'll see how it goes tomorrow. Why long? Why am I looking long when you're seeing what's going on here? A couple key things. One, I think that this is setting up the push. Two, that was the movement that we saw today was a move up. We saw the gap. I think it's going to continue. Three, they were stepping us up all day long. And the market's rolling, and I just want to go through this. The market's rolling why this is going on. We're being stepped up on this little name while the market's rolling. The easiest way to determine your relative strength is just take the name and divide the name by the index. Look at how this is getting stronger and stronger against the index. We're actually grinding higher as the index was dropping. So if you're struggling with day trading and you're struggling with your intraday charts, I've set up this video. It's 10 minutes long. It's free. There's no ads in the middle of it. It's at the end of this video. Watch it. I think it would greatly help people stay with the trend and stop with the counter trends. And if you find value in this video or that video, please share them. My goal is to get information out that is actionable, that people can actually use to make more informed decisions the next trading day. Have a great night, everyone.